Well, hello, this is Jim Musgrave with Research Financial Strategies, and thank you for watching the monthly market summary for July 2015. So we are in August, and we are in the summer doldrums here, but we are in the same sideways pattern we've been in all year long. On the surface, the markets may look relatively calm, but I can tell you one thing: the currents run deep, and there's a lot going on underneath the surface. And I also see some rain clouds on the horizon, but that's not enough reason to cancel your vacation. In fact, if you went on vacation this summer, you haven't missed much because we've been in that same kind of range. But you know what? The tide may be turning to the downside, and I'm going to go over some of the areas that are causing the weakness in the market. And so I'm going to kind of talk about a little bit of the S&P 500 here. On the left-hand side, we have a 5-year chart. You can see we are above the 200-day moving average here. And on the right side, we see a year-to-date chart, and this yellow horizontal line is right here at 2100. You can see the market just keeps on going above and below and above and below, and we've just been in this range for a long time. And during this period, we've seen some volatility. Look at here, we were back in the Greek debt situation, and so we've had some pretty volatile days in the last few months. And here, the day I'm recording this, here on August the 6th, we're having a big down day. But again, I'm not worried at this point so much because we've been in this trading range, and unless we break way below this 200-day moving average, the chances are that we're going to go bounce that back up. So the question is, what's been causing all this weakness? And I want to share with you an article that I get. Again, Seeking Alpha is a source that we have articles all the time from different money managers and analysts all over the country. And this is one that kind of caught my eye, and they talked about a number of different areas that I feel are really moving the markets. And number one is China. We're going to show you what's going on there. So if I bring up the large cap Chinese market, you can see that it's been fairly, it's been volatile, but kind of in a range for the past few years. But look at the fourth quarter last year, and also look at early April this year. It's just the Chinese stock market took off crazy. It was up roughly 60% plus, year to date, up until the high, which hit on April the 27th, and then it just kind of slowly, then rapidly just lost steam. And you can kind of see that huge up and down of the Chinese stock market in a very, very short period of time, year to date. So that is actually a big deal. A similar thing happened in the late 90s with the tech wreck with us, and so you had a lot of retail investors getting on board, investing a ton of money. It went up, and if they got in, during this period while the market's going up, then they didn't catch it way down here, and again, they're down considerably. You're also looking at China is a major economy, and when you have tough economic times in a major economy, then they are not as buying as many goods and services from the United States. And you can combine that with a very strong dollar. Again, this is the dollar index right here. You can see starting last year, the dollar has really kind of taken off. It's come back a little bit, but it's still very, very strong. And so when you combine the cost of goods and services in the United States to be purchased by other countries with different currencies, in combination with some weakness in the economy, that's going to affect earnings of U.S. companies. And we're just finishing up earnings season right now with the companies, and some have been okay, some have not been so good. And so that could be a contributing factor to why we've seen so much weakness. Find the bond market. Let's kind of talk about that for a moment. I always go over the bonds. And you can see that, again, bonds are still down a bit, probably roughly 1%-ish year to date. So if you're looking at the bond portfolio in your 401ks, your TSP, it's going to be down a little bit, but at this point, it's not a whole lot to get worried about. It's just part of the volatility in the bond market. And we actually, if you go back to 2013, obviously when there's a spike in the interest rates, the bonds really got hit hard. So we're not quite to the point where we were in 2013, but it's certainly, we don't like, no one likes to lose money, especially in their parts of the portfolio that they consider safe. kind of moving on a little bit to equities. I'll hit some of the sectors real quick. I want to talk about the NASDAQ for a moment. So here is the NASDAQ, and you can see it's been fairly stable. But again, we've seen some recent weakness in the NASDAQ, and a lot of that has to do with, you guessed it, Apple. Okay, everybody has their iPhones and iPads and so forth, and for some weird reason, we've seen Apple sell off since, I guess, July 21st or so. I mean, look at it. That's a pretty big drop. And I don't know if there's a significant fundamental reason why the stock price is dropping, but it is. And Apple is owned big time in the S&P 500 as well as the NASDAQ as well as XLK, which is a technology ETF. So anyway, if Apple's not doing well, then that's also going to be a drag on the major indexes as well. And you can see, again, just to refamiliarize you, this is the market forecast. So when you see this green line right here, you want to be above 80, which it was just in late July. But look at that, it is just taking a dive, and it's down, around 10 right now. And so once you get under 20, that's considered very bearish. And so we have, in a very short period of time, gone from very strong and healthy bullish to bearish in Apple. Now, I don't think it's going to stay like this for very long. And again, Apple's a huge company, and they're not going anywhere. But again, that is one reason why some of the major indices may have taken a bit of a hit, is because Apple is such a huge player in the indices, and when it shows weakness, it kind of acts as an anchor for the rest of the market. EFA is the European stock market. You can see it kind of peaked last summer, had some major weakness in the second half of the year, really showed some life year to date. Then you have the Greek crisis, which kind of made that drop, and you can kind of see this is during the whole Greek debt crisis, and it's kind of rallied a little bit, but again, it's showing some weakness. Over a 5-year period of time, it's above this 200-day moving average. Or year to date, it's touching it. So again, there's been a bit of life in the first half of the year for European markets, but again, there's some short-term weakness there. Last thing I want to talk about in the U.S. markets are small caps, and small caps up until fairly recently have outpaced large caps, but now small caps are underperforming the large caps. And we've seen some weakness here, just a little bit more weakness than large cap. So that's a little bit of what's going on right there. But the real story is what is going on with commodities. Oh my gosh, oil is just falling out of bed. I mean, look at oil back in 2011 and just how it's just dropped in just in the last year. Look at that last year on June the 30th, 2014, it was all the way up here. Now we're just, it's just dismal. Have we hit a bottom? I don't know. We're pretty darn close if we aren't. I mean, we still have some room to go in terms of to the downside, but I just don't see oil dropping that much more. I mean, I guess it could happen, but we've got to be near a bottom somewhere. But again, you look at the weakness in the market forecast. I mean, I've never seen something down below 1 before. So I mean, oil's been very, very weak. And the other thing too is that one of the leading indicators that we look at is copper, and copper has also shown weakness for many years. And again, year to date, I mean, look at this; it just keeps on dropping. So it's certainly below where it was at the beginning of the year. And so copper is a leading economic indicator, because when you're building buildings and cars and trains and just stuff, there's typically a demand for copper. And again, everything is a supply and demand, and when there's not so much demand, then obviously the price is going to drop, and that's what we've seen. So that is a economic indicator that's showing some weakness in the market for sure. So just to kind of recap the overall markets on where we are, let's look at the bullish percent for the S&P 500, and you can see from March to the present how more stocks have been kind of losing some momentum. So roughly 50% of the stocks in the S&P 500 are in positive territory, 50% are in negative territory. You look at the bullish percent for all stocks, and you can see we've seen a little bit more weakness in the overall stock market. Only 44% are in what we call positive trend or in positive areas. And finally, you look at the world stock index, and we're even just slightly more weak right there at 42. So again, we are going through a period of weakness. And as I said, I say this every single month, is that when you look at a bear market recession, which is the definition is the S&P going negative 20 for 3 consecutive quarters, that happens on average every 5 years, and we're about 6.5 years into a bull market. So I'm not saying, I don't predict a bear market. I'm not saying it's going to happen like anytime in the near future, but the chances are that it will happen, and you got to be prepared. We don't know if this is the beginning of a bear market or not, but you just have to be prepared, and you need to have a plan to get defensive when things really start turning ugly. So, we're kind of seeing some warning signs that things aren't as strong as they could be. But at this point, it's best not to get to panic. I would again, keep your positions, be well diversified. Now's not the time to go to cash, because the day you go to cash, within the next week or so, the market's going to rebound, and we're going to miss out on those gains. So I don't suggest that you go to cash at this point. Now, I'll leave you with one idea. If you don't like the volatility of stocks and bonds, and you're looking to own investments that are a little bit more stable and produce a much higher dividend than cash and bonds right now, somewhere in that 5 to 7% dividend range, there are some alternative investments like non-traded REITs or business development corporations that may be a good option. And I own a number of these in my own personal portfolio, and I've talked to a number of clients about them in the last few months. So I'm not going to talk about alternatives in this call today, but I do plan to do a webinar or two in August and September. So if you're on my email list, you will receive an invitation to attend that. If you're not, you can always go to jimmusgrave.com, go to speaking and workshops, and see what I got lined up in the future. So that's all I got for the month of July. Again, things are starting to, some gray clouds are on the horizons, and I'm a little concerned, but I'm not to the point of getting completely defensive at this point. But if you'd like to discuss your accounts, if you're not a client of mine and you want me to review what you got and give you a second opinion, I'm happy to do that. Just give me a call at 301-588-0514 or send me an email at jim.musgrave@rfsadvisors.com. I'd be happy to talk with you and do a review. And until next month, I hope you guys hang in there and enjoy the rest of your summer. And just give me a call if you need to be in touch. All right, have a great day.